Hey everyone, me Kevin here. In this video, we're going to talk about the third largest cryptocurrency network, Cardano. We're going to talk about some of the differences between Bitcoin, Ethereum, and Cardano, why I'm so interested in Cardano, am I investing in Cardano, what happened on Sunday, what's happening on the charts, everything that we need to know about Cardano. But first, before I get started, I want to invite you to get cash back, or should I say crypto back, every time you swipe your credit card. Check it out. If you go to metkevin.com/CC, metkevin.com/CC, you can earn rewards every time you swipe your credit card in cryptocurrency. So check it out, go apply, go to metkevin.com/CC for a credit card to check out the BlockFi Rewards cryptocurrency credit card. All right, folks, let's talk about Cardano. So Cardano is a network like Bitcoin and Ethereum are. And Bitcoin is deemed to be generation 1, mining to verify transactions and proof of work to verify that you are a legitimate miner, so to speak. Ethereum is deemed to be generation 2. It also follows mining and a proof of work architecture, but it allows DeFi through smart contracts, which is kind of cool. We like decentralized finance. We see a lot of hope in it. Now, Cardano is generation 3, and so is another network called Polkadot, but we'll talk about that as in a different video. That's their token DOT, and that is a competitor to Cardano as well. And there are many other altcoins, even a shout out to Solano and other coins. But in this video, we're specifically going to focus on Cardano. And Cardano, third largest cryptocurrency here, tries to solve some of the problems of Ethereum, specifically high gas fees, especially for transactions, and speed issues, which Cardano tries to solve both of these, and the fact that it uses a lot of energy. Now, Ethereum is fast-ish. Sometimes you have to wait in sort of queues or pay higher fees to get things moving faster. And because Cardano uses a proof of stake model, it is deemed to be less expensive and more efficient, solving the issues and now being able to process smart contracts as well. So let's break this down a little bit because I just said a bunch of things that might lose some of y'all, especially since we talk so much about stocks and real estate on the channel. And of course we talk about crypto as well, but we've got to break some of these things down just to make sure you're caught up to speed. So if you're used to this, you can fast forward a minute or just listen to it anyway to get my take on this. So brief overview, okay? Proof of work and proof of stake are both versions of verifying transactions, or they establish your right to verify transactions, your legitimacy to verify transactions. In proof of work, which is what Bitcoin uses and what Ethereum currently uses, and we'll talk about Ethereum 2.0 in just a moment. But in proof of work, you're basically solving computational problems for transactions to verify that transactions are accurate. These transactions are puzzles that are designed to be hard to solve. And only the computer that mines the transaction the fastest and correctly ends up verifying the transaction and getting paid a reward in the proof of work concept. This creates a lot of competition for individuals and it burns a lot of power. Current estimates are that Bitcoin burns over 115 terawatts of power per year. Now, Bitcoin maximalists say that that's okay. We've got to get to this threshold of burning a lot of power, and then we can support a lot of transactions without actually the network extrapolating in its power use, because once it's up and running, it's kind of like turning the light on. It's on. Now we can do things under it, and we can do things under that network without in a large way increasing our energy use. It's an interesting argument, but still burns a lot of power. And even though we hear things like, oh, but 70% of Bitcoin energy use uses some form of renewable energy, the statistics are really unclear what some form of renewable energy is. For example, just because a Bitcoin miner uses one solar panel could in theory make them using some solar or renewable energy, and that obviously doesn't mean all of their production is renewable. Now, obviously, with China's latest ban, a lot of fossil fuels being burned in China for crypto mining, and this ban on crypto mining, we've seen a lot of crypto mining move to Canada and North America, which is great. Especially shout out to companies like Hut 8 Mining. Super excited about the company. But what you're seeing is a frustration over the energy use for Bitcoin mining. And the second problem is it takes about 10 minutes to process a Bitcoin transaction block. That means it takes up to 10 minutes for a Bitcoin transaction to be validated. That's a lot of time, and some people make the argument, hey, if you were buying a cup of coffee, you don't want to wait for 10 minutes for the register to go, boom, all right, your transaction went through, right? Now, there are arguments that there are upgrades that are going to come to Bitcoin to solve this, to make Bitcoin, rather than just a super secure store of value, also something very useful for transactions. But Bitcoin's failures here have given rise to Ethereum. But Ethereum, while it can process transactions faster, much faster than Bitcoin, the fees are high. And the fees are high, and the energy use is high for Ethereum to actually process transactions. Ethereum presently still uses a proof of work model as well. Proof of work means we're burning a lot of energy just like Bitcoin, but a fraction of the energy that Bitcoin processes. So that's a good thing. We're already improving, right? We're going to less energy use, but we're still in a proof of work model. This brings up proof of stake, which is very different. Staking really refers to people depositing their cryptocurrency or their asset, their coin, into a pool known as a staking pool. That money in that pool then acts as a validator to ensure integrity and security in the network. And really, rather than a bunch of competitive miners trying to verify proof of work transactions, what you have is every individual staking pool for Cardano getting randomly assigned transactions to verify based on the size of their staking pool. So if they have about 3% of all coins in their pool, they'll get randomly assigned about 3% of transactions. Now, there are redundancy measures obviously built into all of these different cryptocurrencies. I like all three of them. I don't want anybody to think I'm bashing Bitcoin or Ethereum here. I love all three of them. Just talking about Cardano to introduce you all to it a little bit, but staking makes a lot of sense. If individuals are placing their money into a pool, it's essentially a version of them saying, I trust this pool with my money. I'm going to give this pool my money, let this pool verify transactions, and then when we verify transactions, we'll get paid on those transactions. And that's how in the DeFi space or in the staking space, you can get paid a yield on your cryptocurrency. It's because you're getting paid for verifying transactions. Problem though, until Sunday, has been that Cardano has not in mass been able to enable smart contracts. But that all changed this weekend. We finally got smart contracts on the Cardano network, which is really exciting because we've now moved on to a period of time or an epoch known as Epoch 290 via the Alonzo upgrade. And this Alonzo upgrade finally enabled us to have smart contracts on our Cardano network, which is exciting because this now means not only can you stake your Cardano, but you can do NFTs and many different things. I'll talk more about smart contracts in a moment, but it's worth mentioning that this is getting so popular, just sort of a quick sidebar, this is getting so popular now that there are even companies, and this is not sponsored, like Bitcoin Suisse, as opposed to Credit Suisse, there's Bitcoin Suisse, and not sponsored, which allows you to stake your Cardano without lockup periods and offers you staking backed loans in addition to paying you for staking your crypto. But then they'll also offer you loans. It's incredible. Now, I personally get scared of taking out debt on crypto. I never recommend that, but I just want you to know kind of how much this is evolving. It's incredible. So anyway, Cardano now enables smart contracts, which is super exciting, and that's really what this Alonzo upgrade on Sunday brought. This means we can now, and I wrote down a list here, this means we can do things like swaps, NFTs, stablecoins, microfinance, microinsurance, insurance in general, crop insurance, trials for science, faster settlement. You could sell your data. You can, some people say do real estate transactions. You could kill the middleman, blah, 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 blah. To me, look, I love smart contracts. I want to be very, very clear that I'm bullish on smart contracts. Ethereum has been using smart contracts. Ethereum NFTs, we hear about these all the time. Ethereum currently supports 13 transactions per second, which is much better than Bitcoin. Cardano, however, not to one up, but Cardano right now supports 257 transactions per second, but both of these are still totally babies. I mean, Visa does like 30,000 transactions per second. And in fairness, shout out to Ethereum, Ethereum does expect to scale up in the future to 1,000 transactions per second with the release of Ethereum 2.0, which is expected to come at like the end of 2022, maybe beginning of 2023. But then at the same time, Cardano also expects to upgrade to hydroscaling, where it would enable 1 million transactions per second, which is like, whoa, that's like 25 times as much as Visa uses, right? Anyway, a lot of information there. Basically, upgrades coming to these networks all of the freaking time. And since we're talking so much about smart contracts, it's worth just giving a quick example. And I'm going to go into my opinion where I think there are benefits and where I think there are failures of smart contracts. So smart contracts are designed to be very black and white. If you can program an if-then statement into a contract, then it's good. If I receive $5, I will give you an NFT or an insurance contract. But one of the problems, and this makes sense, right? It's kind of like you put $5 into PayPal to buy a Fortnite skin, you get the Fortnite skin. Everything should work totally fine. You put $1 into a vending machine, you should get that bottle of soda or whatever. And the theory is that these algorithms that exist in the cryptocurrency network will essentially have access to your money or your product on each side and immediately bestow rights for each thing. The problem where, in my opinion, smart contracts get a little bit blurry is when people start suggesting that smart contracts are going to be able to take over everything, like getting rid of escrow in real estate or lenders in real estate, just because, in my opinion, and I believe there's going to be a lot of automation coming here. I'm not trying to bag on smart contracts. I just want to be clear. There are a lot of cases where discretion is required. Consider this. What happens when there is a leak on a property? Let's say, I'm gonna give you a real example because this happened to me. So I have an insurance contract, and let's say water backs up out of my toilet, and the sewer backed up. And the insurance company will only pay the claim if there was actually damage from this backup to the other part of the property or somewhere throughout the property. But they will not pay the claim if there was no damage because they don't cover sewer line damage, but they would cover water damage on the inside. So like the sewer's broken, backs up, they don't cover that. This actually happened, okay? But if the sewer floods the house and there's damage, they cover that. But somebody, like a human, in my opinion, has to determine, okay, this backed up in a bathroom. Did this damage happen because the shower, somebody let water out of the shower? Was it pre-existing? Is it present? Is it debatable? Were there pictures before and after? Now, I think algorithms can get us very, very far. So don't get me wrong. I'm very, very excited about smart contracts in algorithms and systems. But I do think there are going to be a lot of things that will still require a human touch, like underwriting for people. Can we underwrite somebody's loan without a human? Many would, I think, argue, yeah, you can. Look at credit score, DTI, you either fit the box or you don't. But look, I was a licensed lender. There's a lot of discretion. There are a lot of things that are like, hey, write us a letter of explanation about this and let's try to sniff out if there's fraud or not, right? So there are a lot of things in life that are discretion based. So I think we can't go too far yet, assuming smart contracts are going to totally take over the world and you're not going to need real estate agents anymore. And personally, I don't care, okay? I am a real estate broker, so bias aside, I want to be fair though, I don't do transactions anymore. I use other real estate agents who send me their deals. People call me up, they're like, Kevin, there's a good deal. I use them to sell it to me. Like my license, I don't use it at all. So I'm just trying to put all my biases on the table, but then also tell you like everything that I've got. So anyway, in smart contracts, there are going to be issues here where there's discretion. And anytime there's discretion in DeFi, you lose the benefit of things like fraud protection or FDI insurance or potentially, and I don't know, and potentially, what about errors and omissions insurance? Because what if like your underwriter or your attorney makes a mistake, right? And you want to sue them? Well, there's no DeFi court system. But this is where things get interesting, and this is me speculating, okay? This portion has been my opinion. This is me speculating. I wouldn't be surprised if for these discretion things in the future, you kind of have this contract where you go through all of the if-thens. Okay, do you qualify, or was there a leak? Was there damage? Yes, no. Those are all simple if-then, if-then, if-then. But maybe then you get to the discretion question and you use smart chain or smart contract technology and DeFi protocols to put up for a vote. Hey, do we think this one part of the transaction, was this water damage caused by the water backing up from the toilet, which was a cause of the sewer, or which was a result of, I should say, of the sewer backup, or was it pre-existing? What does everybody think? And maybe it goes out to like a special pool of DeFi, building renovation contractors or underwriters in the DeFi space, right? And they get paid for basically their expert vote on something. Who knows? I don't know. I mean, in theory, I think there is a way to have almost this like dispute resolution through smart contracts by putting it up to a vote of many experts and then paying for that. So I think there are solutions where discretion comes in, but I want to be clear, this is very, very young technology. It's very easy to go, oh, smart contract solution to everything. But when you start looking at discretion in life, it's like, oh man, yeah, there could be a lot of discretion involved. So anyway, worth noting that. But again, I imagine a future where these are all solved. In the meantime, though, kind of rewinding back to smart contracts, Ethereum is obviously booming with smart contracts. This is like all NFTs are almost Ethereum-based. Well, I shouldn't say all, because you've got plenty of other DeFi protocols right now that do their own. A lot of them are Ethereum-based, though. It's worth noting. But there are plenty of other coins that do NFTs as well. But anyway, Cardano. This Sunday, within 35 minutes, already had 35 smart contracts up and running for what it's worth. There has been skepticism with Cardano, though, before even this Sunday. One notable issue was that there was a decentralized exchange, or DEX they call it, known as MinSwap. And MinSwap ran into what was called a concurrency issue using Cardano. Basically, it meant that only one transaction could be done per block, which every block is 20 seconds in Cardano. And this is really a problem because think about the easiest analogy to understand concurrency is think about like a punch bowl, and imagine you're at a party. Usually if you're at a party and there's a punch bowl at the middle of the table, you could in theory have a bunch of people reach in and grab bowls of juice at the same time, and somebody could be standing above pouring in juice, right? Well, a concurrency issue means one person can't take at the same time as somebody else is taking, because what if there's only enough juice for one of them? And a concurrency solution is making sure that multiple people can interact with that punch bowl at the same time. I'm way oversimplifying, okay? I understand that. And if you have a simpler analogy for me, please leave me a comment down below. I will read them. But anyway, and this is already good, though, because compared to Bitcoin, you're processing one block every 20 minutes. Ethereum does a block in about 10 to 20 seconds, so you've got some similarities here. But there was a problem with MinSwap in Cardano. And some folks who've looked into this believe that the issue with Cardano's concurrency flaw here was that somebody basically took their smart contract code from the Ethereum network and tried to apply it to Cardano without properly adjusting for Cardano's code. And so you've had Charles Hoskinson say, hey, this is nonsense, like there's no issue here. If you actually wrote the code correctly, we wouldn't have issues. But this did lead to a little bit of chest pain for some folks involved in Cardano. And we saw the Cardano price fluctuate a little bit because of this. So worth noting that there are always going to be issues, but generally we're going to get through to solutions in all of these cryptocurrency things. And I really haven't taken the time to talk about my thoughts on smart contracts yet, and especially Cardano. And I have to say, the more research I do, the more excited I get about my portfolio allocation, which I want to look at Cardano in just a moment here on we'll do some TA. But I think it's worth mentioning that my portfolio is, future allocations are going 20% Bitcoin, or to get my portfolio to 20% Bitcoin. It's a little unbalanced right now because I already have larger Bitcoin positions. But anyway, 20% Bitcoin going forward, 40% Ethereum going forward, and 40% Cardano going forward, ADA. I'm very excited by this, but I'm kind of having this 3-coin basket here to diversify a bit within the cryptocurrency space, and then I am keeping cryptocurrency at under 5% of my portfolio at the moment, so for what it's worth. But let's also now look at some TA for cryptocurrency. It's worth noting that I originally bought good chunks here of Cardano right around here, middle of June and middle of July, while Cardano was dancing around $1.06, $1.08, $1.12. We had some purchases right around $1.33, $32, $29. And recently it's skyrocketed to as high as $3. So for all those of you who get alerts in my Stocks and Psychology of Money group, which is linked down below, 40% off for another 10 days, you can see all my buy-sell alerts. I send them every time, options, stocks, crypto, everything. Whether I lose or make money, I'd be very transparent about it. But anyway, we also bought some of the dips over here, somewhere around 232, which is not too far off of where it is right now. But what's worth noting is when we zoom in over here, we're going to get to where we had our Alonzo upgrade. And there's something fascinating that happened here. There were a lot of media reports that Cardano was going to skyrocket because of Alonzo. And this was Saturday right here. Saturday's when Cardano all of a sudden went from somewhere around $2.43 to $2.80. We had this massive push on Cardano here because a lot of folks were saying, that's it. Cardano's going to go to the moon. And so it attracted traders, lots of traders who were looking to make a quick buck over the weekend. And you got all these traders surging in. I think that's what led to this breakout here of Cardano back to the 280 range. And then unfortunately, when the Alonzo upgrade started going live, we actually had a fall right before, and actually the network went live right here at about 2:45. So you kind of had this fall right before the network went live, and then you had this continued bleed out the rest of the day just a bit, back down in that 237 range. And I really believe that this right here was just fugazi by the rumor, and this was sell the news. Nothing went wrong with the network, but I think people were expecting, oh, Cardano's going to surge because all of a sudden this network's going to go live and people are going to buy a $10 million NFT through Sotheby's on Cardano. Like, I think people's expectations were a little kooky for this Sunday because the Cardano founder, Charles Hoskinson, who is the co-founder of Ethereum, he said himself, this is supposed to be a non-event. Like, a good launch is nothing happens. A good transition is literally no news. And so no news was good news this Sunday. And that's what we got. No news is a good news. So really, in my opinion, this surge should have never happened. We should have stayed in this channel right here. And then really, you wouldn't have seen any of this nonsense that we had in the last few days. This right here was just noise. And so now we're kind of back in this channel over here. And this is what I'm watching is this channel. Really, it's a little bit of a wide one, but it's between that 250 to 230-ish range. Kind of a triple channel here. I've only got 2 lines drawn, but you kind of get the picture. So anyway, I like Cardano. I personally would love for it to fall back to the $1 range because I'm very bullish about it and I'd be happy to buy more of it. RCC is obviously something I'm interested in right now, which is real estate cash crypto. And then we'll transition as other opportunities come up. Inflation came out today, a little bit lower than expected, but cryptocurrency held pretty well, even though inflation was starting to kind of show its little sign of peaking and inflecting down. The next 2 months should be pretty interesting, though, with the September and October inflation readings coming out October and November. So we'll see if we get a bigger drop in those 2 months in inflation, and if that has any impact at all on cryptocurrency. So my thoughts on Cardano, a little bit of TA, a little bit about smart contracts and background. Let me know what you thought about this video. Really appreciate y'all. Thank you so much for your support. If you like this kind of content, make sure to hit the subscribe button. It lets me know that you like this content and to make more of this content. And folks, we'll see you in the next video. Thanks. Bye.